Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, October 10th, 2018. Um, Although we had quite the day in the market today, pretty nice move down. Believe it or not, this will be one of the shorter videos because we don't have to spend a lot of time on the intraday charts anymore. This is after a day like today. Intraday charts are a mess. Number one, you had a big, the Qs were down, almost 4.5%. Instead, just kind of destroys the short-term 15-minute charts. We really don't. We were focusing on those for micro levels and trend lines and support levels. So all that's not really too important right now. I think what we'll focus on here is the daily time frame. Look at these daily and weekly charts right now. So starting out here with QQQ. This is a daily chart. I'm just going to jump over to 2-day chart. And again, harp on this trend line. This is a long-term trend line, comes off the mid-2015 lows in QQQ, although the NDX itself, the NASDAQ 100 and SPY, S&P 500, everything else started right here in the early 2016 lows. That was a little mini crash in the Qs. And despite today's, how much we were down. We didn't have any type of irregular trading. There wasn't any type of flash crash. This is just a down day, and I'm going to get to that in a minute. It's there we've seen worse. Let's just say that. So that's the trend line. And what I wanted to point out, and we zoom back in a little closer here, a couple things. Number one is that it's a pretty significant long-term multi-year trend line. So it's not unusual to see trend lines, support levels, I should say, whether they're price support or trend lines, pretty key levels, get taken out on a daily basis, only to see the markets close back above on a weekly basis. So we'll flip over to the weekly charts in a second, but keep that in mind. There's still chance, and maybe we even come down here and hit that 169.60 target before we recover, or maybe we don't recover. I still highly favor recovery of that level. I went home long. I think we bounce tomorrow, most likely, and into the end of the week. But we'll see, because anything is possible. I'll get to that. Well, maybe I'll talk a little on the end. I don't want to get off on. Let's stick to the technicals. Then I'll talk about, what happens and what is, and I'll just mention that now. This is what happens when you have a very overcrowded trade. I'm talking about index investing, the tremendous trend in recent years away from passive or active fund management, active stock picking. People were technically, quote unquote, firing their fund managers. Hedge funds have been closing because stock pickers can't beat the indexing. But that trend, it's a dangerous trend. If you've read about it, you'll know what I'm talking about. It can't continue forever. You get all money piling into companies, regardless of their fundamentals, just because they're a top component. And even worse on these index funds, you have a big concentration in the largest holdings. So when that goes the other way, this is what happens. So, and my point is, this could continue to happen. Sometimes you have these big, sharp, unexpected moves. Well, unexpected depending who you are and how you're looking at the markets. Like I said, this was, my preferred scenario here, but I'm talking the professionals, the fund managers and all that. So if what happens, sometimes you have a big move down or a couple strong days, and funds, especially those that employ leverage, they can break, and when they break, it gets ugly. They continue to unwind. So we'll see. Right now, where I don't think we're there yet. This is just I don't want to call it a run-of-the-mill down day, but while I'm here on this chart, let me just show you something. So to put it in perspective, I have this line right here. What I did right before the video. This is just going back this year. So back in early February, looked like early February right here. What I'm doing is I'm placing this line. I already measured out that red candle right there. I put it on, and what that does, it measures that candle from top to low. It was a big red candle, and so that's how much we dropped that day. And here's another red candle about that size from high to low right there. You can see as I put it on here. I don't know. Maybe sometimes it's hard to make it out in the videos. There you go. There we go. So there we go. That day right there, we had that down day. On the range on that day was about the same as this one. So now let's move forward back to where we were today. And I just again want to show you that if you're new to trading or investing, this didn't even match those days right there. So we could have fallen more, and it's not the end of the world. And again, it's I'll show you something even more interesting. Well, that's just showing, kind of putting things in perspective for you as far as today's move. But if you want to see something really interesting, turns out that bear flag did play out to the measured target. I think was it this morning or yesterday? I did this video and I showed you the measured target. The measured target of a bear flag pattern is the impulsive move leading down into the formation of the flag. Again, it was covered, I think, on the daily chart in today's video, but I believe I covered it here. I already had that flag drawn. Let me put this trend line here, move it up there. So there's our bear flag right there. That's a continuation pattern. You take the impulsive move down to the bottom where the flag forms, and then you take that, drag that line, add it right to the highest point of the flag, which I've done right there, and voila, look at that, to the button. And it's weird, I thought this one might fall a little short of that, but I'll tell you, I've traded many, many years, and it never fails to amaze me how many technical patterns, not just bear flags, all types of head and shoulders, wedges, other bullish and bearish chart patterns, very often hit their measured target. Not always. I usually, will focus on a supporter level, resistance level, but I wanted to point that out. That's uncanny. You can see to the button that measured move played out there. So that's it. So that's why I think that's, from a technical perspective, putting all the fear aside, for those that were long and got crushed in this, it's a move down. It's slightly undercut this trend line, which was I said would be the next target if 178 went, and that and again we could come down tomorrow, maybe a pop in the morning, a little more panic selling, a little more margin calls, clearing out, blowing out the longs. I'm sure that happened today, heading into the lows. Undoubtedly, a lot of longs got blown out, and that's the other thing. In the past I put up charts, and you can Google these that show historical margin balances going back, and you'll see at the top of bull markets margin balances peak. And what that is, that's not shorts loaded up on both. Those are longs, people that are chock full of Apple and Amazon and all that. And then you have the unwinding of the margin trade. That's what exacerbates selling. That's why stock market corrections, especially bear markets, are so powerful. It's just the unwinding. It's not only, fundamentals eventually start to shift and follow the charts, but you have the unwinding of margin. So that's that. So long end of it is we are just we closed a little bit below trend line support and a little bit above 169.60. Whether we have a little pop down, gap down the open, they buy it up. I highly favor reversal, but I have to say this that if you're trading, and you got to use stops because you can't rule out a sudden swoon down. I don't think it's coming now. I watch a lot of metrics. I look at credit spreads, things like that kind of warn of cracks underneath the surface. I don't see that now, but the big question is I don't know how much more margin unwinding or if any big fund is broken after today. I doubt that. And that could then lead to some more downside. So be careful there, but I do favor a bounce, and I still do favor, and I'll make it very clear, more downside coming in the weeks to months to come. So I've been saying for a while I expect a significant correction in the fourth quarter this year. That started October 1st, and I'm talking well into the double digits. I don't know, let's see. I'm actually haven't measured this one yet, but from the highs to the lows, we're only 8%. We're 8% off the highs, so technically not even a correction yet. A correction is defined by a drop of 10% or more off the highs, whereas a bear market's typically a drop of 20% or more. But I still think we're going to get that correction or bear market beginning in the fourth quarter of the year and come down here to at least test these lows, as I said, from earlier in the year, around that 154.45 level. So just to make it clear, preferred scenario right now, bounce up. That 178, I think I even mentioned it this morning in the video, would be an objective shorting level if we get there, but you want to see the charts confirm. I think once they start bidding this up, if the market stabilizes, dip buyers are going to feast on Apple and Amazon like you've never seen. However, there's been some technical damage on those charts. I'm not going to get into those now. I'll maybe put some charts up on the site for members of the leading FANG stocks. Just wanted to show you that. So that's what I'm looking at now. Let's just focus near term now. Looking for a bounce tomorrow. Preferably, and if anything else happens, if we get some very impulsive selling, we take out 169.60, then you might want to get out of Dodge or be very careful there. If you have shorts, just trail down stops. That always works. And again, for swing traders, don't be overly concerned with all the micro bounces. Before we leave QQQ, quick look at the weekly chart. Here's a 10-year weekly chart showing all the divergent highs, all the corrections. Always get the feedback. I just want to say this to the YouTubers. I appreciate the comments. The vast majority of those are constructive and supportive. I don't mind constructive criticism at all. But the ones I get are usually divergences don't work. Divergences don't work, and they do. And we've had some very clear bearish things building all year now. And the first one did result, that first divergent high resulted in a 12% correction roughly. This one so far has resulted, as I showed you, about an 8% correction. But uh, as I said, divergences themselves are not a buy or sell signal, but merely an indication that a trend reversal is likely. This was a sell signal here. We had it last week. It was confirmed. We had breakdowns on the daily chart, this weekly chart, bearish engulfing candle, solid close below this minor uptrend line, this wedge, and there it is. So we closed today on that. I've harped on this many times. I love this 40-week moving average. It does a bang-up job on Apple and QQQ and a lot of tech stocks as acting as support or resistance. You can put it up on your own chart. Look at the primary trends. Remember, this was a period of choppy sideways trading back in 2015, 2016. We had some big corrections back there, 26, 18% on QQQ. So you tend to chop through these trend indicators, but you look at the bull trends, and that 40-week moving average or 200-day fits like a glove on Apple and QQQ. So it's support. We haven't touched that support level since back here. Last time we visited, both those corrections earlier in the year were stopped by that 40-week moving average and this trend line. They both come in together. It can go. This tells me that trend line will likely go. It could go tomorrow. It can go this week. Be careful. In other words, game and counter trend balance right now, in my opinion, is picking up nickels in front of a steamroller, especially longer term. But that's my preferred scenario since we just tagged it for the first time in a while, a little bounce, and then that might provide some objecting short entries on the way back. We had several trade ideas on right side of the chart, hit profit targets today right around the time the indexes fell to these supports too. We're out of our TWM trade, hit the final target. Nike hit our first target. There's some others that are close as far as our short trades. So that's that. And so there's the near term and longer term outlook. And remember, sometimes you get these divergences build, and then boom, this is what I'm talking about. This is the dangerous part here, where if we do melt down, now that support has been broken and all eyes are seeing it, I should say, no, not this long-term support line yet. Watch this at the end of the week. If we close down below this one at the end of the week, it would have similar implications as smaller trendline break had this week, if that makes sense to you. But again, hopefully a little bounce here. That's the way I'm positioned. We'll see. SPY, long-term trend line, bull market trend line, comes off the March 2009 lows, and voila, we're just a hair below it. That's not unusual. This is a weekly chart, as I often say. The only thing that matters when trading on a weekly time frame are the end of week closes. That's your candlestick body, not these little wicks down here. Or I should say tails or shadows of the candles. Here's two that I just circled that went well below both that trend line and the 40-week moving average on SPY. Right now we closed slightly below trend, but just above that 40-week moving average on SPY. And again, it does a little bit better job on QQQ, but here it is. Big picture says, look, we just had our first bearish crossover since back here. And this bearish crossover back then was it didn't indicate, a market top. It just said, hey, correction coming. We had a bearish crossover on the SPY PPO on the weekly chart. We were the most overbought we've ever been in most indexes at that point in time, on the weekly and the daily, if I'm not mistaken. But again, no divergence. This time around, it's different. It's actually different in my opinion, because now that confirms this negative divergence right here. So if things get ugly this week or next, whether we get a counter trend bounce or not, that opens a door for that move I'm looking for a back test to these earlier lows. And to be honest with you, at that point, if we get a reaction on or around that level, probably undercut them. My guess is if we get down there, we'll undercut these lows, then reverse. But ultimately, it looks like more downside from there. So again, that's all longer term stuff. We'll see what happens if and when we start to approach that level. SPY daily chart took out this trend line this morning when I did the video, and we never looked back. There was bulls could have tried to regain that level, but they failed to. So we fell down. That next my target once that level went was 279.67. We overshot it by a bit, but again, this is what I refer to and believe is a momentum fueled overshoot. When you have a lot of downward velocities, stops are getting hit. There's that downward momentum tends to often carry you through a support level. So this level can still be defended is what I'm trying to say. And again, a lot of reactions that define that level there, reactions there, reactions there, reaction there. So that's what I'm looking for. And if they can't, if the selling continues to, build this week, we have another red day tomorrow, red close. We can't regain that level, sooner in the session tomorrow, the better. But if the markets bleed off overnight and gap down, then this is what you're looking at. I don't see much support until we get down to about 270 or so. That's certainly, again, a possibility based on these longer term divergences and everything that's been building for a long time. So I wish I could tell you with certainty whether we're going to bounce tomorrow or continue lower. All I can say is that when you get this oversold, you're stretched. Let's see, on the daily, remember the other day I mentioned that we were not oversold yet on the RS Daily RSI. Now we are. In fact, this is the deepest oversold reading we've had in years. This is a 2-year chart you're looking at. Even back then on these two corrections, we just tagged that 30 level. This time we were down, closed the day at 23, and anything 30 or lower is considered oversold. So oversold at or near support. Bottom line is whether this market melts down or not, it's not objective to certainly not objective to initiate short entries here, and it's not very objective. The outlook, the near term, very near term risk reward, in my opinion, is not favorable to remaining short because of the deeply oversold conditions right now, and the fact the market is at or very near support. So that's it. We'll just have to wait and see how things happen tomorrow. Again, if the markets can stabilize tomorrow, then you'll probably see the dip buyers coming in with both fists, and at least it might be a very fleeting rally, it might be quick, maybe not, but usually we already had our little consolidation period. I don't think we're going to consolidate very long. I think we'll tomorrow probably snap back up or down one way, but we'll see. Like I said, we're really just a little shy. It would have been nice, to be honest with you, if we could have come in and hit that 169.60 level and got it over with. Usually when you get real close to a key support level or price target, it's like a magnet. You come in and you hit it. So, all right, well, we'll see what happens tomorrow, and I'll take a look at the futures overnight and in the morning, and at the very least for members of the right side of the chart, I'll post something if I see anything, any developments before the market opens tomorrow. But as of now, that's what I'm looking at. The likelihood for a bounce, potentially sharp counter trend bounce, is there. And again, markets are moving fast. Volatility is high, so you have to have your ducks in a row, your trading plan ahead, already identified where if you want to get short on this market and we get a quick snapback and we hit support, you may not have a lot of opportunities to short at that level. Or if you're long and you realize, okay, hey, now maybe this guy Randy's right. Maybe this market is going lower, and I didn't take some of my longs before, but maybe now I should start lightening up on those longs. So same story. If you're waiting for a move to new highs, hey, maybe it comes. From what I'm seeing, I don't think. I think we probably put in the highs for the year. There's a good chance there. But I can't write this market off. I cannot and will not until these primary trend lines go on a solid closing weekly basis. And that's it. There it is on QQQ. And there it is on SPY at primary long-term bull market trendline support, which looks like it's going to go sooner or later, but it hasn't yet. That's it. We'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.